What is the most important financial line item that Warren Buffett, arguably the world's greatest investor, looks at when analyzing any income statement? It's the gross profit margin. Warren spends the majority of his time analyzing the gross profit margin of any company he intends to invest in, because that figure, more than any other, gives him the best indication of the company's ability to prosper long term. In this video, I'm going to show you how Warren Buffett reads and analyzes an income statement and how you can use that information to make sure you're making the best decision when it comes to investing in a company. Or, if you're a CFO, you can use this information to find better ways to improve your company's financial metrics. To do this, we're going to look at 6 years worth of income statements for our example company, Apple. Okay? Now I chose Apple because it's an easy financial statement to read and also a company in which Warren is heavily invested. My name is Nelson Alvarez. I'm a CPA and executive management consultant. My mission here in the C-suite is simple: to put you in the C-suite. And I do that by giving you actionable insights that will excel you to the corporate level. Okay? Now time is money, so let's dive right in. Now on screen here, you can see 6 years worth of income statements for Apple. Now this information all came from the company's 10K, which is its financial statements that are publicly made available. I took a few liberties in putting the financial statements into Excel, but it's still functionally the same and the numbers are still identical to its 10K numbers. Now, when reviewing the income statement of any company, what is the first thing Warren does? Well, as I mentioned at the beginning, the first thing he does is calculate the gross profit margin percentage of any business. Now, you can find this number or percentage in a company's financial statements, or you can just calculate it yourself. It's just net sales minus cost of goods sold. That gives you your gross profit margin. Okay. To get the gross profit margin percentage, you just take your gross profit number and divide it by net sales, okay? That gives you the gross profit margin percentage, or the GP percentages for short. Now, the GP percentage to Warren is arguably the most important number on the income statement. Why does Warren consider this the most important number on the income statement? Well, technically, the higher your GP margin, the better your business is performing overall. Now, that may seem obvious to you, but let's really try and understand what Warren is after. It's not as simple as you think. Warren would rather invest in a business that does $100 million a year with a 40% GP margin than a business that does $1 billion a year with a 10% GP margin. Although the larger business does billions more in revenue, Warren would rather take the one with better gross profit margins. Now, why is that the case? What is the GP percentage margin really telling us? Well, per Warren, a consistent GP margin of 40% or better indicates that the company and management has some type of sustainable competitive advantage. It's essentially reliable from a business perspective. What Warren is looking for is to see gross profit margin percentages of 40% or greater for at least 7 to 10 years before he decides to invest in a company. That is essentially what he is ideally looking for. Now, why that long? Why does he need to see consistent GP margins of 40% or greater for at least 7 to 10 years? Because that level of consistency for that long indicates a company and management with rock-solid values, processes, and a product or service. It really indicates that the business has its act together and can weather economic storms and weather personnel turnover. It also seems to always have a product or service that people need year-round. It's not like Christmas decorations where people only buy them once a year in the winter. We are after consistent margins because we want a consistent return on investment. Now, looking at Apple, I only have 6 years up here, but you get the point. Looking at Apple's GP percentage, we can see that it's steady at around 38% for the last 6 years. That number is really good, like seriously good. Apple is meeting Warren's criteria for consistently high GP, so he checks the box on that. Now on the flip side, Warren tends to avoid companies with a GP percentage margin of 20% or less, because that indicates a highly competitive field with a lot of players. He also doesn't like to see sporadic or inconsistent margins, GP margins of 60% one year, 20% the next, because that indicates boom and bust cycles, okay? Not very reliable from an investment return standpoint. And again, that is what we're after. Remember, the lower your gross profit margin, the harder it is to establish yourself in an industry and really pull ahead. And that's primarily because the company is not taking in enough money to expand and potentially buy out suppliers and competitors. You have to understand that the goal of business is expansion, not necessarily in sales and products, but just growth in an industry. You really should be buying out suppliers, competitors, and other stakeholders in your industry that are connected to your business, okay? It's been proven time and time again that this is the best way to stay relevant and to make sure your company doesn't become obsolete. However, if you have tight GP margins, you're not going to be able to do so. Tight margins are a bottleneck on your business. If your business is basically living paycheck to paycheck, its operations are going to be run the same. The GP margin of a company really tells you about management's priority. A low GP margin indicates that management is simply focused on keeping the company alive, not really adding muscle or meat on the bone to the company. That margin percentage right away should let you know instantly what you are getting involved with when you invest in that type of company. It's really critical that you understand the domino effect a GP margin has on a business. Warren understands this better than anyone and has made his reputation and living off of that logic. If for the last 10 years you've had a 10% GP margin on $5 billion in sales, statistically, there's very little chance that margin's going to change over the next 10 years, okay? It's just pure mathematics. Now, low GP margins don't necessarily mean it's a bad company. It can still be profitable. What Warren is saying is that if you invest in a company with less than 20% GP margins, it's just going to take a lot longer to get your money back, whether that's through stock dividends or appreciation. And the company's more susceptible to natural economic disasters because of those tight margins. Follow Warren's rule here if you want to successfully invest. The lower the GP margin, the less you can grow, the longer it takes to return a profit, and the greater the threat of business obsolescence. When Warren makes an investment, he wants his money to grow quickly, okay? Which is why he looks for companies that have 40% GP margins or better, because money comes back faster with those higher margins. It doesn't matter if the company does $10 billion a year or $500 million a year. He'll always go with a company with the higher gross profit margin. Now that's just criterion one when moving down the income statement. There's a few more, so let's hit those next. Super important to note, and although I'm not doing it here, it is critical that you compare any of your target company's financials to your most immediate competitor. What Warren does for any company he looks at is he also has side by side the next closest competitor's financials. So for example, Apple, Warren would have Apple's financial statements open, as well as Samsung, Microsoft, and Alphabet really side by side to compare their margins. Review of a company's financials can never be done in isolation. You need context to understand how a company is performing relative to its competitors. 40% GP margins are great, but not if everyone else has 45%, okay? That's why it's important. You need to do a side-by-side comparison to competitors. Now let's keep moving down the income statement of Apple. Remember, this is just an example, but the same analysis will apply to no matter what the company you're looking at. Now let's talk about operating expenses, which include SG&A, which is selling, general, and administrative, R&D, which is research and development, and depreciation, okay? Those are your main operating expenses. Operating expenses serve the purpose of supporting your GP number. They're important. You can't run a company without accounting, marketing, IT, or sales. So how does Warren analyze operating expenses? Well, first, he takes a ratio of each expense bucket, SG&A, R&D, and depreciation, to the gross profit number. He calculates, for example, how much is SG&A as a percentage of GP. In this case for Apple, SG&A as a percentage of GP is approximately 11% over 6 years, which is like truly phenomenal, guys, okay? Really it is. Many times, a company's SG&A to GP could be 40 to 60% of its GP number, okay? So Apple really does have it good here. A high SG&A number to GP percentage indicates a lot of operational resources are being spent on supporting that GP, which is not a good sign. The fewer resources operationally used to support the GP, the better. Now again, we haven't compared that number to Samsung or Microsoft, and that's what Warren would do next, okay? So make sure you're also doing that with your immediate competitors to your target company. However, overall, Apple's SG&A to GP number is a good number. It's super low, okay? That means it's efficiently using its resources to support that GP. Okay, second next largest operating expense for Apple is R&D expense, research and development. As a general rule, Warren tends to stay away from companies with a high R&D expense to GP. Now, why is that the case? Why doesn't Warren like investing in companies with a high R&D number as a percentage to GP? Well, the thing about companies with a high R&D expense is that they're constantly having to reinvent themselves. I want you to think technology, auto, and pharma companies. They need to be constantly coming up with the next big thing because they're in a highly competitive industry with a customer base that demands the latest and greatest. If companies in this industry ever cut their R&D budget, their GP will decline and they'll basically die off, right? One misstep and there goes their sales base. The thing is that the R&D for these companies drive their sales, okay? That is their main sales driver, R&D. If they ever stop investing in R&D, they will collapse, okay? That's how dire it is. These companies are caught in a vicious cycle. This is why Warren tends to stay away with companies with high R&D, okay? Because one misstep, it all falls apart, okay? There's never-ending risk involved in companies with high R&D expense. You could spend $10 billion developing a new product, but it could be a total failure. There's a lot of money wasted in R&D expense and trying to come up with the next big thing, or just something that works. However, with that said, when we look at Apple's R&D expense as a percentage of GP, it's on average only 14%. Okay, that is very low. That is very low and very good for the world's most innovative company. This is primarily one of the reasons why Warren is heavily invested in Apple. Now, although Apple does spend billions and billions on R&D, it's low as compared to its GP percentage, okay? That indicates a clear competitive advantage. As a general rule of thumb, you want to avoid companies that have an R&D percentage to GP of greater than 30%. As always though, make sure you're comparing to competitors, okay? Now the last operating expense is depreciation expense, okay? Now much like R&D expense, Warren does not like to see high levels of depreciation expense as a percentage of GP. Now, why is that? A high depreciation to GP percentage margin indicates a business that is capitally intensive and has a lot of competition. Capital intensive businesses suck cash right out of a business. Companies that have high depreciation expense tend to have a lot of factories, equipment, supplies, and software. Now, Apple, on its financial statements, actually owns a lot of software, and it uses that software to produce its own software. However, looking at Apple's depreciation to GP percentage margin, it's only about 10%, which is again, really, really good. Yes, it's a capital intensive business, and yes, Apple expenses about $10 billion a year in depreciation. However, that $10 billion of depreciation helps support $100 billion in gross profit, okay? That's the key ratio that we're looking at, and that's why it's a wonderful number. Now again, as always, be sure to compare to competitors, okay? 10% is great for Apple, okay? But if Samsung has a 5%, there should be something to look at there, okay? And you shouldn't write that off. And finally, we arrive at the operating profit, okay? The operating profit is a key metric in understanding a business's overall economics and cash flow. The first thing Warren does is look at a company's operating profit margin percentage and compare it to competitors. And then he asks, is this number consistent over 7 to 10 years? If so, it's most likely a prime target for investment and well worth his time considering. Now looking at Apple, its operating profit margin is 25% over the last 6 years. Again, that is wonderful and it's ideal. And this is kind of why we're looking at this statement. We're looking at an idealized version of a financial statement and one in which any company would really want. Again, we're always comparing to competitors. If everyone has a 25% operating profit margin, then no one is really doing anything special. Not saying we shouldn't invest, but we're looking for the ones that really stick out because that indicates a competitive advantage. But again, it's got to be consistent over 7 to 10 years. Let's keep moving down the income statement, okay? Next, we're going to look at interest expense and interest income, which are no longer operating expenses. These are actually financial costs that have nothing to do with the operations of the business. Now, the first thing Warren does for interest expense is to take that number and compare it to the operating profit margin and get that ratio. A high interest expense to operating profit margin indicates a cash-intensive business with a lot of competition. High interest expense to operating income could also signal the company was bought out under a leveraged buyout and is now just servicing that debt, but you have to check the company's 10K for that to be sure. More importantly than the last two things I mentioned, high interest expense to operating income generally indicates that the business doesn't have good economics. It indicates that the business essentially doesn't generate enough cash to self-finance. If your operating income is $1 million a year, for example, but your interest expense is $900,000 a year, that means your net income is $100,000, okay? And that essentially means that your business is on life support, okay? Because the interest expense to operating income is 90%, all right? That's what's really telling. That is what you have to understand about a business. Is it debt-ridden or can it self-finance? Warren tends to avoid businesses that are entirely funded by the banks, basically, okay? That's what that interest expense to operating income ratio tells you. Is the bank supporting this company or can the company stand on its own 2 feet without that many bank loans? What Warren is after are cash-sustaining businesses that require very little debt to operate. Now, looking at Apple, if we take its interest expense and divide it by its operating income, we can see that it's a mere 4%. Now that's really good, and it's also a sign of a competitive advantage and with the fact that it can self-finance, okay? So this is why Warren is really interested in Apple. It doesn't need a lot of debt to operate. Now, what you should also recognize is that Apple's interest income actually eclipses its interest expense. So Apple's technically never actually paying interest, okay? It makes so much money on interest income that it's basically become its own bank. This, believe it or not, is actually one of the hidden gems that really drew Warren into the company. The company makes more money in interest income than it does in expense, to the tune of billions. Typically, for non-financial service companies, when you see interest income that exceeds interest expense, that means that the company generates so much money it doesn't even know what to do with it. It actually has to lend it out in order to make money on its money, okay? So that's a real telltale sign and why Apple is still pretty valuable. So what's actually happening is that Apple is buying stocks, bonds, and equity stakes in other company, and it's getting the interest income from that, okay? It makes so much money that it's investing in outside companies. Apple essentially argued and reasoned and figured out that allocating any more money internally to its own R&D won't produce that much, okay? It's going to have diminishing marginal returns on its business, which is just textbook economics. This is why Apple is the poster child for financial statements. Now, unless you're a bank, the vast majority of companies spend more in interest expense than they take in income. And that makes sense, right? A lot of companies are trying to self-finance their own core operations, but not Apple. It makes so much money, it doesn't make any economic sense to put it back into its business, so it has to lend it out into the market to make money on that money to basically still get a return. That reason right there is why Apple remains one of the most valuable companies in the world. Now let's look at the final expense that not many people pay attention to, but Warren has found can give you a real glimpse into the mind of top management. What we want to look out for is companies that have inconsistent tax expense from one year to the next. Why is that? Warren has found that companies with inconsistent tax expense are actually battling the IRS. Now, if the companies that are doing that are willing to butt heads with them, there's more likely than not some type of shady accounting practices going on within the company, okay? Not all the time, but Warren has found that generally that tends to be the case. So please do some investigating if you see a company's income tax expense all over the place. And it's a fair point that Warren makes as well, okay? Companies that are truly profitable have no reason to butt heads with the IRS, okay? They have so much money, they're just gonna pay the tax that is due. Apple, in our example, has a good track record of consistent tax expense, okay? It's not up and down, it's never zero from one year to the next, okay? It's steadily coming down over the last 6 years, and it's mostly due to it taking advantage of its tax breaks. Now let's move down the financial statement and look at net income. Companies with net income of 20% or more indicate that GP is high, expenses are low, and that the company is expanding its business to purchase suppliers, competitors, and just acquiring stakes in other companies that fit its overall mission, okay? That is what the net income percentage tells you. Companies with net income percentage consistently above 20% are generally good and safe companies to invest in. If you've learned nothing else in this video, please know that companies with net income above 20% are generally good companies to invest in. Companies with net income percentage of 10% or less tend to be in highly competitive industries and are also not being run that efficiently. You have to remember that every business is 100% capable of being a great business and having margins like Apple has. Nothing stops a business from being great, even in super competitive industries. What generally prevents businesses from succeeding and being great is management, really the people in charge. Management has to be self-aware enough to know when their company is caught in a vicious cycle of low margins and high interest payments in order to work themselves out of it. If you're stuck in a low margin business and you do nothing to diversify yourself out of it, you may be stuck in it forever. And lastly, if we're a public company, we want to pay attention to earnings per share calculation. That is your net income divided by your shares outstanding. Now again, with all of our ratios here, we want to look at the EPS trend of 7 to 10 years to see where it's generally headed. A well-run company will generally have increasing EPS percentage over 7 to 10 years, okay? Doesn't have to be huge, just needs an upward trajectory. What this indicates is that the company basically has enough cash to self-finance and expand and to buy back its stock, all right? That's really what's gonna drive the EPS calculation up. And as a note, further, what we really wanna see is a company consistently buying back its own shares because that indicates it has excess cash which to Warren is a great thing. Generally, companies that are buying back their own stock are not struggling to operationally stay afloat on a day-to-day basis, okay? They most likely have very good margins and can generate a lot of cash. Companies with erratic EPS numbers tend to indicate a boom or bust cycle or a very unstable industry or business. Warren tends to avoid those companies, and we should too, okay? Now, if you are one of those companies, you really want to find a way to diversify your net income, your gross profit, to stabilize your business so that your EPS can become more consistent over time. That's it. That's how you read an income statement, okay? These are the tactics that Warren uses, great companies use, and even I use, okay? They really do work, and they give you the best insight into a company. Financials really do tell a story, and undoubtedly, Apple's tells an incredible story. Apple's financial statements, particularly its income statement, are a model to other companies of which they could really only dream of. This is why Apple is still the most valuable company in the world. In the next video, we're going to discuss how Warren analyzes a balance sheet, so I hope to see you there soon.